Good morning, everyone, and welcome to the Daily Hunt for Multibaggers. It's Wednesday, December 17th, 2025, and we're ready to dig into some fresh market insights based on the data we collected yesterday.
That's right, Ethan. Yesterday was quite a busy day, with a significant number of posts and discussions across social media, flagging quite a few different stocks for our analysis.
Yeah, definitely a lot of buzz. We saw a mix of strong community optimism for some names, alongside a healthy dose of skepticism and caution for others. Overall, I'd say the sentiment is pretty mixed, a blend of promising growth narratives and some high-risk scenarios. Let's get right into it.
Kicking things off today, let's talk about Pfizer Inc., ticker PFE. Our analysis shows an overall bearish sentiment, mostly driven by past performance. It seems users are really questioning any short-term bounce, despite some speculative options plays.
Well, Brooke, even with that bearish sentiment, PFE does offer a pretty compelling dividend yield at 6.74%. For a long-term investor looking for income, that's certainly something to consider. There's always that hope for a turnaround, even if it's speculative.
Hope is not a KPI, Ethan. That negative revenue growth of nearly 6% is a serious red flag, especially with all the news about declining COVID-19 revenue and cautious 2026 outlooks. Plus, a 66.53 debt-to-equity ratio isn't exactly giving them a lot of wiggle room. It was never rated before, and frankly, the current data doesn't offer any compelling reason for a buy.
Fair points, Brooke. So for Pfizer, it sounds like our verdict today is a clear stay away.
Absolutely. Next up, we have Rigetti Computing Inc., RGTI. This one is looking very bearish. We're seeing talks of forced selling due to an ETF rebalance, dismal fundamentals, and a valuation that frankly looks completely disconnected from reality.
Rigetti. It's in the quantum computing space, which is an area with massive long-term potential, right? There's always the hope that strategic partnerships could speed up their path to scale, making them the next big thing down the line. It's a speculative play for sure, but the industry itself is exciting.
Exciting maybe, but the numbers don't lie, Ethan. An EPS of negative $1.46, negative revenue growth of over 18%, and a staggering price-to-book ratio of almost 21. Not to mention, insiders have sold over 740,000 shares. The CEO even owns Cerio shares. We've rated RGTI as stay away many times before, most recently earlier this month, and nothing here suggests an upgrade. This company is burning through cash.
Yeah, that insider selling is tough to ignore. So for RGTI, it's another stay away from us today.
Moving on, let's discuss Netflix Inc., NFLX. User sentiment here is a bit limited, mostly an indirect mention of NFLX concerns impacting other stocks. But fundamentally, Brooke, Netflix is still a powerhouse. Their revenue growth is solid at 17.2%, and an impressive net profit margin of over 24% shows they're highly efficient. They're expanding with new podcast partnerships and even potential strategic alignments with companies like Warner Bros. Discovery. That's a strong growth story if you ask me. I agree the fundamentals are strong, but the valuation is a concern. A PE ratio of nearly 40 means a lot of future growth is already baked in. And with a beta of 1.7, it's a volatile stock, meaning any market downturn could hit it harder. We rated NFLX a stay away just last week, and while it was a cautious buy earlier in December, the current market sentiment about big tech makes me pause. The risk-reward just isn't quite there for a new entry today.
So despite those good growth metrics, we're sticking with a stay away for Netflix?
For now, yes. And finally, let's tackle Tesla Inc., TSLA. The community sentiment here is truly unique. There's a strong belief that Tesla defies traditional market logic, driven by a loyal following and narratives around robo-taxis and AI.
That's exactly it, Brooke. People literally say never bet against Elon's fanboys. There's a palpable belief that even if current earnings wobble, the future potential in AI and autonomous driving will send this stock soaring. Insider buying is also positive, showing some confidence, and Mizuho just upped their price target to $530. It's been a speculative gamble for us recently, and you can see why the community is so optimistic.
Optimism is one thing, Ethan, but a PE ratio of over 326 and a price to book nearing 20? That's an astronomical valuation. And while their revenue growth is positive at 11.6%, it's nowhere near the hypergrowth needed to justify those numbers. Analysts are saying 2026 is a make or break year. The risk of a significant correction if those future narratives don't materialize, or if competition heats up even more, is substantial. This is a repeat of our previous speculative gamble and stay away ratings.
I hear you on the risk, Brooke. It's definitely a high-stakes play. But for today, given those KPIs and the inherent speculation, it's another stay away. All right, so after all that analysis, let's quickly round up today's candidates. Investigate as buy. None. Investigate as cautious buy. None. Investigate as speculative gamble. Tesla Inc. TSLA. And that wraps up another episode of the Daily Hunt for Multibaggers. Remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Absolutely. Thanks for joining us today. We'll be back tomorrow with more market insights.
Happy hunting!